Hey everyone, Travis Nixon, Tyler Tucci coming at you. It's the afternoon of June 15th. We just saw the Fed meeting come out and 75 basis points. We're going to discuss a little bit. We're going to talk through what Foliko thinks about what's going on in the market and how we should be thinking about the week forward. Tyler, thanks for joining me.
Yeah, thanks for having me. Those days like today are, if you love markets, these are the best days, right? We haven't had I think we've had one 75 basis point hike in the last 30 years. So, what we had was pretty historical. Decent day for Foliko longs as well, which was interesting after kind of a poor morning for some of our preferred mining stocks, both precious and commodity metals. They staged a pretty decent push into the close. If I could just highlight GFI or BVN here, those are two of our favorite by upside. We look for continued strength over the next 12 weeks in these. So that'll, if we're putting that data into context, that suggests that, there is a limit to what the Fed is willing to do in terms of choking off inflation. I would expect, if gold is to perform like gold and, the inflationary assets perform like the way we think they're going to over the next 12 weeks, we should see, some higher inflation prints, a Fed that only is willing to go 50 or 75 basis points. I guess there's, they do seem to keep pushing the envelope. So that would be bad for the trade if eventually they decide that they do have the will to break, inflation at literally any cost. I think we're still a bit ways away from there, but they did just hike 75 basis points today, which is really fast, right? Like, I think that's important to think about is
75 on top of what they've been doing, right? On top of signaling they're going to do more later on in the year, right?
Right. And to your point, that's really the important piece. And that's why, mortgage rates, for example, have got a little unglued in the last 6 months. Is the forward trajectory of the policy has some real impacts. And I actually do think in a way, I will keep an eye on mortgage rates because there is a level for the Fed that I believe will be unacceptable. Whether that's 10, 12, 15, I'm not quite sure, but given the way the US real estate market is and how, subsidized it is, whether it's through GSEs or, these other things, it would be very, very difficult to see that kind of not happening.
Yeah. Well, so speaking of performance for the day, let's go through, this is my Robinhood account here. And so what we have on the top, that's the actual portfolio. I went all long today. Here's my 5 picks that came out of, I wake up at 6 every morning and go through Foliko data. I decide, what I want to get into for the day, do a rebalancing every day, really, for me. So the top 5 is what I held, made just over 4% today. It was a good day for me. You can see on my same Foliko research there, I had the 5 potential shorts. I'm getting closer to be able to integrating shorts and not just going long into my portfolio here. So we can see at least, my longs are doing a lot better than my shorts, which is really where I want to be coming in here. But the whole market generally lifted pretty well today, given the news. Did you expect that, Tyler? Did you think, though, that 75 bips would lead to an increase in the S&P?
Personally, I actually was a bit more pessimistic, and that's like when we talk frequently about having a systemized, data-driven approach as opposed to a panic-driven, P&L-driven approach, right? Like, so that's the interesting thing about this is, yesterday looking through Foliko data, it was pretty clear that metals and mining stocks were the place to be, today on a risk reward basis. So, that actually kind of helped me temper my bearishness, I suppose, especially when things really didn't topple over this morning like I would have expected to if we're going to have some follow on. But, I think 75 basis points is pretty rapid, especially because it really didn't seem like, he promised to never do it again, right? So, there's a situation where, the Fed could hike another at least 2% this year, right? So that I can't imagine would be great for risk assets across the board, right? This would be the first time that we've had a discount rate, of note in quite some time, right? Like, that you actually have to start thinking about all the other factors when it kind of turns against you, right? Like we've been talking about the last, basically since the financial crisis. The Fed has had your back, right? So, even if in instances like, 2018 or other drawdowns and correction, ultimately they did take their foot off the brake, right? Whether it was adjusting how they're going to do QT or adjusting forward guidance or whatever that is. That's just not the case this time. So, and that is something that Foliko data is picking up. We're still pretty bearish semiconductors. The trade.
To the point on 2018, lifting their foot off the brake, did lifting the foot off the brake in 2018 and not making those hard decisions like they are today, did that lead to the environment that we have, and perhaps just COVID delayed things a little bit down the road?
I mean, it did it help? Probably not. But what happened in 2020 was, incredible in terms of the monetary and fiscal stimulus, impulse combined, right? We've never seen anything like that. That's the closest thing to real helicopter money we've ever had. So like, that's why we're here. That part is 80% of the explanatory variable here. Yes, sure. There's another 20% of other stuff, but really what happened is, they turned the money hose on and it got a little weirder than I think they could have anticipated, right? So, the market is now regulating that, right? Rates across the board are going higher, which usually as a somebody with a fixed income background, Fed over tightening usually means a flattening curve, usually means, lower 30-year and 10-year treasury rates. But instead we have over tightening, and we have runaway mortgage rates, which are tied to the long end of the curve. And, we bonds can't catch a bid, right? So it's a very, very interesting backdrop. It's quite different from, the last inflationary experience we had that everyone loves to point back to with Volcker. The jobless rate was already way higher, right? So he was just turning something that was bad a little bit worse, right? Like currently the Fed's plan is to destroy your 401k and your job. And if that gets inflation down, great. They really couldn't care less. So that is the question, right? Is do they have a point at which they will blink? I think there's a level on mortgage rates that probably makes them start to reconsider what they're doing. But absent that, it has to be a credit thing. Like they'll watch the S&P go down another 1,000 points. Like I don't think that matters to them whatsoever. I do think some of the other channels, the credit channels and things like that, where the economy has to be, functioning, right? Otherwise, that's a whole different kind of disaster. But absent those kind of things, they don't care. So it's been interesting kind of seeing that, at least my interpretation of that view in Foliko, where it's, buy metals and mining stocks. There's one or two other, of the growthier names that we've turned somewhat constructive on, but the rest of them, it says you can wait. It says, by date, you can wait until August or September.
So in an era though, where the Fed does not have you back, I want to go back to your point on that. Fed doesn't have your back. They're not worried about your 401k. I think we're definitely in a market right now that you can't just lock into a tech spider and just let it ride. I think that you've got to be smart about your trades. You've got to look for where the real value is. And it's interesting as Foliko is coming out. Look, so I'll bring back up for a second, though, my Robinhood trades for the day. Again, these trades came from ideas derived in Foliko. First up, think about Snap. Snap is not a company that I would just by myself think, yeah, I need me some Snap today. Up 10%, 10.5%. And that's pretty wild. These are names. Everyone gets stuck in the trap of focusing on the stocks and the tickers that people talk about, right? These are tickers that people generally aren't talking about. Snap, of course, there's some attention there. But, Then you have things like Gold Transportes Eros, right? Up 9% today. Huge win, right? This is what's coming out of Foliko. So in an era where a stagnant strategy is really not going to serve you, let's take a look at exactly what can Foliko do for you. So how are you looking at this, and how are you balancing, what to do in the midst of this wild environment?
So when I'm looking at, unless I'm isolating for earnings, then we can talk about what I do. But if I'm looking at a theme or a thesis as opposed to an individual stock, I'll look at a bunch of the kind of the surrounding names, right? So like you can start to paint a picture where, for example, all those names were, I would, with all due respect to everybody working at those companies, the stocks are kind of garbage right now, right? Like, it's,
Please, Tyler, tell us what do you really think, man?
I consider that like a trash rally, right? Like, the market runs, like crazy with all this stuff that nothing changed, right? Like, there's no, they're not building another airport in Mexico, and they've, somehow procured an oil rebate. Like that didn't happen, right? And the stock moved 10% anyhow, right? Like, which is amazing. But, when coming into today, when you looked at those names, it strongly pointed to the idea of, this is like a signature bear market squeeze, right? You just squeeze the absolute, worst of the worst, and you can squeeze it pretty hard, right? As you saw, right? So, that's not to say like it's a bad trade. I love those trades, right? The red to green squeeze style trades are, have been quite profitable pretty much no matter what market regime we've been in. So it painted a picture of, some of these lower quality companies really, really squeezing, right? So that kind of just fit with our.
Well, let's walk through it then just a little bit here. Oh, you haven't been able to hear me, have you?
No, I was just trying to type that into the.
I was trying to turn my video off so we could focus on you being picture in picture. Okay, look, I'm learning this. How do I turn my video out without? How you feeling about the recording so far?
I mean, I think it's going, pretty good. Like that's the thing, right? If you can get a real community of people to pay attention and care about this, right? Like the whole infrastructure, like is very accretive, right? Like you can just always, there's just deeper to go, right? Like, if you're willing to partner with us going deeper, we can go deeper, right? Like I mentioned the sector report, right? Like where we're just literally like 1, 2, 4, 16 weeks. Here are all the ETFs. Here's what we're doing about them. Or, in the case we're not trading those specific ones, because I mean, we can't trade everything at once. It just we're just not there yet. There's not enough manpower to do it.
Yeah. But well, so Tyler, let's take a walk through some of these sectors then. Tech. I mean, Foliko's coming out. It's seeing. I'm seeing a ton of red here in tech. 176 sell rating, 61 watch, 8 buy. And if we go into those buy ratings, I mean, what we're seeing is not your typical tech purchases that everyone would typically get excited about. And mostly those purchases are seeing strength on a 1 week rally bubble type of horizon, not much else beyond that. What's going on in tech? Are we, and your view of this, Foliko's negative. Are you thinking that we might see a rally in tech anytime soon? And how does this change, if at all, from the recent Fed movement?
I mean, any kind of, bear market kind of situation, you're going to have squeezes and they're going to be massive, right? So like that's the trick, right? Is if you look across time, the biggest up days have actually been in bear markets, right? Like, because we'll call that a not healthy behavior, right? In a healthy market, the market doesn't swing, 5, 6, 7%, right? So, it's just kind of the same story, right? All the capital who had been initially buying this dip has gotten completely eaten up. Some of these lower quality names don't have as much institutional sponsorship, especially I saw some Chinese tech names in there. And those have become a compliance issue for some institutions, right? Like, because it was fool me once with all these Russian equities that just completely froze and went to zero. And, everyone is kind of forgiven for that because we had never seen that before. But if you get caught holding, some of these other names that are less liquid and whatever, it might be a problem for you this time around. You may not be able to get away with saying, well, I didn't know, now you should have. So, I mean, that's kind of the thing, right? Like we can't have a sustained business, sustained rally without both, an improvement in sentiment in general and institutional sponsorship, right? Like ultimately that's the thing that, either holds up the market or allows for, cascades, right? Like, if there is institutional buying, if they need to be adding on the way up NVIDIA and they need to be adding, Apple on every dip, right? Like you're just not going to knock those. You're not knocking those stocks over, unless we get some kind of weird shock, right? Like it happens, but generally speaking, that's not what's going on. But yeah, I mean, maybe I'm overlaying my own view slightly onto what Foliko's seeing. But it just kind of confirms to me that we have one more like capitulatory event, I think, before we really start to try to think about putting in a bottom. I've been monitoring the single name data and the single name price over time model data, and we really haven't had that many flips. And that's what, we'll make sure we're out in front of everybody when it does flip, but it just hasn't. Like, it's just more and more bearish. And like, some of these forecasts that we're well on our way to seeing, come true have just been, pretty grotesquely bearish, in fact, right? Like,
yeah. To the point that we'll even touch base, you and I, in the morning and say, like, are we sure that it's this bearish? Think about the rally from last week and the week before. Everyone was excited. Everyone was losing their mind. In fact, I remember people saying, should the Fed even go 50 for this next one? I don't know what happens. Everyone forgets themselves whenever there's the slightest hint of rally. Foliko saying, yeah, and actually what's crazy is Foliko actually spotted a rally happening, right? In the midst of all the loss from weeks before. It was saying, no, rally's coming. It hit Foliko's, everything went negative. I mean, last week, everything was going negative. And we see the impact of this today. If we look more broadly, just market generally, look at the earnings power score coming from March, right? So in March, we actually saw market overall. And by the way, for everyone watching, I want to bring you along with us. This is an overview from Foliko of 6 health scores that we produce. So we ingest an enormous amount of data and information, have compiled it for the past 7 years, and using this enormous amount of data, we can come out with a view of 6 different dimensions of health for a given company, or we can roll that up to a sector, or further, as you see on the screen right now, you can roll that up to the market overall. And so what we saw was actually trending a little bit positive in the late February, early March on the earnings power Since that time, this has just bled out to just be really, really weak. We're down to minus 0.21. And I think that speaks to a bigger problem the market has overall. I think we've got to get through, Tyler, a terrible earnings season before this is actually going to come out and be right. And I actually think that the market might interpret a bad earnings season as a sign for hope. But generally, I don't see a way around it.
Right. Yes. Like in a scenario where we have basically, some pretty bearish price targets on a bunch of the semiconductor names right up into earnings. So in that scenario, right, you could potentially have a situation where, we sell off in anticipation of earnings. And maybe there's a situation where earnings are so bad where it's like, okay, this is it, right? I don't, on a macro basis, that's a bit tougher of a sell for me with fuel, housing, and food, inflating at like double digits, right? So like it's a bit tougher. Like when I try to think about it that way, but that's the beauty of having this data, right? Is that we're able to remove ourselves slightly, and the model's biasless, right? Biasless to the point that it'll give a prediction that's so crazy we don't even believe it, right? And it's not because we made an error, right? Like that's the prediction, right? So and that's the interesting thing about this. I probably would have stopped out of our metals and miners trades like 100 times, right, in the last 4 days, right? Because they just keep showing weakness. It just wouldn't behave, right? Like, and through this, it's like, okay, we keep seeing these same things show up. So if we have a repeatable signal, we should act like that. So so far so good.
Now this is a little interesting too, though. I mean, if we were looking earlier at the 10-week, right? We break these signals down to the 1 week, and we see some improvement on those systemic factors that you were talking about. And I think that the economy is going to be hurting until we can get under control the price of energy, oil, and things right now. Things were actually looking up a little bit. Ever since June 7th, though, systemic issues have really doubled down and continued to plague everyone. I mean, June 7th, and then we hit the CPI numbers last week. That was awful for May. Until we see some kind of improvement on this front, are we going to see any potential downgrade in those industrials, in the energy sector, things like that?
Well, that's the concern, right? Is in a systemic sell-off, pretty much everything goes to one, and the correlation of everything goes to one. So your long bond trade gets smoked, your long equities trade gets smoked, your long gold trade gets smoked, long Bitcoin, like whatever it is, your long, how traditionally there has been a the correlation obviously hasn't been one, until I guess, let's call it the 2020 experience. You could pretty much count on higher bond prices on days where equities were lower. Now we're just blowing them all out. So there's a chance, you're long gold, which is a allegedly an inflation hedge anyhow. You're long this gold. And if everything's getting liquidated, if it has a ticker, it's going lower, right? So, that's just the reality of that. And that's something that will, keep our eye on. And that's why when we talk about it internally, I've almost been thinking about it as a pairs trade, right? Like if I do specific ETFs, it would be like long XME versus short XMH, or some sort of derivation of that. That's how I would express the view, right? So yeah, I mean, it's definitely a risk, right? If everything starts to liquidate, that's the problem, right? Like that is why we monitor systemic, right? Like that is, everything could be going great for the company on a single name basis, but you have to sell, if you either have to sell your winners to fund your losers, or you're getting outflows and you just have to take down leverage across the portfolio. The baby gets thrown out with the bathwater all the time. And those are the best trades, right? So like, not that we're rooting for that because we're already long here and we're making the call here, but the hope would be on a throw the baby out with the bathwater scenario that, we're able to find some, pretty substantial upside, following that because right. Like as long as you're losing one to make two or to make three, that's kind of the ethos to me of trading on Foliko, right? Is like, if you want 100% hit rate, like go subscribe with one of these other scammers, right? Like that's just not. But like what will happen is, we can show you, and as we continue to experiment on and ourselves trade a more balanced portfolio, right? Like we have longs, we have shorts, and the thing we are working towards is having, on up days, the longs outperform the shorts, right? Like that's alpha. That's what would matter, right? Like that is what we are doing here. So, if you want a pick service, I'm sure you can go on Twitter and pay, some jabron $99 a month. But, this is like a real process, right? Like you'll be able to, hopefully they listen and subscribe to us and, tune into these videos before the market or after the market. But even without us, right? Like you can use that data to develop a systematic data-driven process, right? Where you're looking for repeatable signals and it's a real plan, right? Because the scariest thing.
And I want to highlight real quick. I mean, we were looking earlier at your semi report. I mean, I'll pull that up, but you wrote an article not too long, maybe a month ago on the semiconductor industry and what Foliko was seeing. And, we actually took a little bit of flack for that article at the time because people, I mean, you think about it, the view in the market in semis has been, this is a limitless demand. And whenever you have limitless demand, how can it possibly be bad, right? And you called something out in that article.
Yeah. And, to Foliko's credit, right, to the day, my favorite short, and by my favorite short, I mean, I'm just interpreting Foliko here. Foliko's favorite semi short has been ASML. And it literally, when you look at the price by time report, it targeted to the day, June 2nd, right? So this is something you'll be able to see when you download the reports on a company, a single name company, right? We'll break down price target by date, right? So you can start to think about, how that would work in the whole context of the market, right? Because we saw higher prices in the semis over a 1 week period, but lower over, and then way low over a 16-month week period, rather. Like, we started talking about like, can we really hit 411 in ASML in 2 months? And, we're on the way. So that's another way you can use this is it spits out specific dates in the forecast, and you can use those as, if you're a technician and from this, like, an exhaustion date or, things like that. So it really is remarkable because as we spent more time with these, with this data, the use case just increases, right? I mean, it started out with, I'm trying to systematize an earnings betting system, right? Using purely the earnings factor, right? So that was one. And then from there, we realized, okay, if you looked at this holistically, it would be interesting to see how this could trade macro, right? Like we had the Fed expectation right today, not in terms of the model didn't tell you they're going to hike 75 bips. It did tell you to buy garbage though. So, that would have worked, just great. So that's the thing we're working towards and for here, right? Is like a real process, because it's important to remember, like there have been periods in history where your investments didn't make anything. A positive return on an investment is not a right. Right. It's been our right since, the GFC, and every time stuff's gotten ugly, as I said, right, the Fed's got your back, buying calls on growth stocks has been, a genius trade for, 7 or 8 years, right? That's over. Now it's time to figure out whatever the new game in town is, for a while.
And I think just to cut in on that, I don't think people, so I think people have this toolbox, right, of how they're going to get excess return. What I think I hear the biggest difficulty people have is the tool to increase the size of your toolbox. How do you start thinking entirely differently? Because if you're just thinking tech, FANG, and just going down growth, growth stocks always winning, innovation, Kathy Wood, all these things. If you can't suddenly adapt and say, I'm out of the tech space and now I'm into individual picks in order to drive something above and beyond, it's going to be a hard time. I mean, the era of stagflation says just that. Sitting everything in an ETF isn't just going to work for you anymore, right?
Right. Your assets go sideways while inflation eats your cash, right? It's yep. The worst case scenario, right? So that's, hopefully what we are helping educate, and ultimately, people make, trading decisions based on, real data, right? Like this is a quant tool for anybody, right? And that's what's cool, right? Like, in my past lives, they've hired, some very impressive people to perform this task, right? Or, teams of people to perform this task, right? We're offering, something that's already in a box. You unbox it and we'll explain to you what we're doing. So it's not just one of these, trust me, right? Like we're trying to keep the trust me to zero, right? Like ultimately the best case is, that there are more power users of this thing, and, I'd be open to them showing us stuff, right? Like, I don't care. Right? Like, if it makes great, like, I'll happily step aside, right? Like, it's not about.
We keep finding stuff out like all the time.
And that's the other thing is like, we're not selling this and, see you later, right? Like we spend hours and hours a day thinking about testing, challenging, trying to destroy this model generally, right? Like, it's a pretty robust process, I would argue, right? From your data science background and from my markets background, we pretty much have it covered, right? In terms of, looking at the trade and then looking at the math of the trade. Did you get lucky? How much of that was alpha? Like, is that repeatable, right? Like, so that's what's really exciting about what's going on here is that, like, you now have access to this. You now have access to us, right? Like, you can type right in the chat, ask literally anything about any name, right? And we'll, give you what we think.
We got that today. Yeah.
Right.
Yep. Well, Tyler, we got a wrap for today. We'll be back and with more on what we're seeing here in Foliko, what we're seeing in the market reaction from the Fed movement today. Join us then. I think next time we're going to be going in a deep dive on healthcare. I think it's interesting to look at, biotech. Where's the growth there? We had an interesting conversation on UNH, I believe it was earlier today, seeing where that's going. So join us next time. We'll be here. Thanks, everyone. Thanks for joining, Tyler.
Looking forward to it. Thanks.